Let's just go to NVDA for a moment. Options chain. And we were discussing implied volatility leans. I'm going to just stick on that because we are doing that webinar on Tuesday. Some of it will cover the implied volatility pumps and leans. But I wanted to kind of get people used to that concept. Okay. So over here on NVIDIA, this is the NVIDIA options chain, and it defaults to the nearest expiration, which is right now May 10th, which will expire in three days. And we see here, these are the option leans that we detected. If I open it up, it shows it for each expiration. And in May 10th, there were 8 implied volatility pumps in the call bids. We found 4 implied volatility leans on the ask side, meaning that there was a negotiation on the ask side. And in the puts, we found 9 implied volatility pumps on a bid, 8 options with implied volatility pumps on the ask. So let's just stick to the May 10th and see, well, how can we potentially use this? So I'm going to close this. And this is a quick way just to scan by different expirations if you wanted to look for implied volatility pumps in a particular expiration. Now I'm going to close this. And to detect these implied volatility pumps, well, what you will see here is that we have the calls on the options chain on the left-hand side, the puts on the right-hand side. And next to each strike, you can see the market. This is the bid and offer in the call, bid and offer in the put. And next to it, we show the implied volatility of the bid and implied volatility of the ask. Same thing in the puts, implied volatility of the bid, implied volatility of the ask. That's running it through, the option pricing. And you could see that that we have them color coded. Usually they're in this green color, but then we have some of these that are in white. And the white ones indicate that we detected that there is some sort of a implied volatility pump where somebody appears to be trying to get a better price and leaning into the market. Okay, because when we look at the market, it's made up of different players, market makers, specialists, professional traders, retail traders, and the bids and offers are made up of all those players trying to compete. And sometimes they're going to better the market because they're trying to execute it for a better price. And they're indicating to the market, well, I want to sell this and I'm going to lean in. I want to be more competitive, but not necessarily go and hit the bid. So let's we're going to change this column from delta to the spread and IV lean. And we're going to do the same thing on the put side. And here on a bid, this is what it's telling us. Why is this lit up white? Well, we could see on a relative basis, now keep in mind, we're not subscribed to each exchange and seeing their limit order book. Okay. And so without seeing that data, we could try to infer what's going on. All right. So we don't see exactly like here's a limit order on the book. Here's a quote. We don't have that information there. The reason is you'd have to, subscribe to exchange, maybe be a member of the exchange to get some of that information. And it would be, thousands and thousands of dollars per exchange. So without that, what's the next big thing? Well, we could make an inference from the data that is available. So the first thing we're looking at is, okay, we see the implied volatility of the bids and the offers on each of these strikes. So on a relative basis, we could see where they're being squeezed in. And here you could see that if we look at the bid, you could see that the bid on the 895 call is 39.3. Then if we go a strike higher, it's 39. If we go strike higher, it's 38.7. So we could see that it's downward sloping. Now, we would expect the same thing on the ask side if these were just broker-dealer quotes. But here we see the offer's 39.8. It drops to 39.3, then goes up to 39.4. So why is this jaggedy here? Something might be going on. So, because why is the option in between squeezed in like that? Okay. So that's the first clue. And then let's take a look at what is the dollar spread, because these options are pretty close together. What is the dollar spread between the option below and the option above? So you could see here that it's 30 cents between the bid and offer on the 895. The 905, it's 35 cents. So from 1570 to 1605. But this one is 20 cents. So that's an indication that either something is on a book, a limit order book, and the market is moving towards it, but not yet ready, or somebody is putting in a pump and it could be floating with the market because they need to do something on that particular line. Either they're trying to reduce inventory or they're trying to accumulate something into their inventory, reduce risk, whatever it is, but somebody is indicating that they have an interest there. So that's how we find and detect these potential implied volatility pumps or leans. Okay, we call them leans. So now we have a lot of them right here on the board. So NVIDIA, you would think there would be a lot just because we just established that this is the most active options in the market above SPY if we measure it in dollar terms of options traded. So if a lot of people are looking, you would think that there would be a lot of competition on these different strikes, which we do see. Right here we go. We could open this up and we see almost in every expiration we've got a decent amount of leans on the bids, on the offers, and the calls and the puts. So this could potentially create some type of an opportunity for us. Now, we're looking at this and saying, okay, there are different ways we could use it. Here we do see, different leans on different options. If we were looking for a particular option, maybe an upside call, we could see where there are, leans and upside calls. Maybe if we were looking for something within a certain delta, it didn't matter if we're doing 25, 20, 15 delta option. We could look at that. We could look at the monies. We could look, tails. Or maybe we're looking at a strategy.
AD?
Yeah.
Rob is just asking, Will, could you please have D explain pump again?
Yeah. So what is an implied volatility pump? Now, most of you are familiar with a limit order. And a limit order is something where you see a market, let's say this is $13.40, $13.60, and you just put in a limit order at a price of, let's say, $13.50, right? Well, if you put in that order, a limit order, $13.50, so it's below, it's below the ask, it's right in the middle. If it doesn't get executed right away because electronically nobody wanted to trade that, what will happen is that order will get posted. It gets posted on the limit order book, and then it gets disseminated to everybody on the open feed, right? So then everybody will see it, and what you will see is that this market will get squeezed from 1340, 1360 to 1350, 1360. So the spread will go from 20 cents to 10 cents. And the implied volatility of that bid will go up as well, right? Because if the option is priced higher, the implied volatility, everything else being equal, is going to be higher. So we would see that on a regular limit order. But what is an IV pump? And that's a different type of way to put in an order. Now, if you're looking at market makers or specialists, their bids and offers are based on the implied volatility inputs. So they're not sitting there and typing in, move the market from $2 to $2.01 if the stock goes up to $2.03 to $2. These are automated electronic quotes. The quoting, our system now is all electronic, right? We have electronic markets, and those electronic markets require computers to continuously update the bids and offers. So imagine, you have a program and you have to update all these bids and offers. But those bids and offers are pegged to the stock price. All right. So if the stock price moves, well, your calls will be worth more, your puts will be worth less. And if the stock price moves up, and if the stock price moves down, your call prices are moving down and your put prices are moving up. But you're not entering in pennies, every time it moves up. Nobody's sitting there and key punching this. It's automated. Well, how do you automate the movement of these bids and offers? Well, you have a model that says that for each of these options, this is the implied volatility bid. This is where I want to buy the options at this implied volatility. This is the implied volatility I want to sell this option, right? And it's pegged to the stock price. So every time the stock price ticks down, your model recalculates what the price should be, the price of the option should be, based on your implied volatility input. Okay, so that's how these markets are moving, because the specialist or market maker says these are the implied volatilities I'm willing to pay per option and willing to sell per option, right? And so a regular bid, if you're a broker dealer, well, you're creating these bids and offers, you're providing liquidity, and your objective is to generate revenue from the bid-ask spread. In other words, if you think something is worth, if you think this option is a 39 in volatility, I'm willing to pay. You're willing to buy it at a lower volatility, sell at a higher volatility, and the bigger the spread is, the higher your margin is. Right? The more you could buy it below your theoretical value, the better. The higher you could sell it above your theoretical value, the better. So you have this implied volatility bid and offer. Okay. But you're also competing with other market makers and specialists, and you're also electronic market makers, and you're also competing with professional traders that have models, and they could peg an implied volatility order. They could just say on one side, I want to buy this implied volatility. Well, to buy that implied volatility, it's got to be pegged to the stock, because the if the stock moves up, right, in a call, well, your call should be moving up. If the stock moves down, your call bid should be moving down because it's recalculating where the stock is. So now that we have that, that's all coming in. Well, if we have a dealer quote and you want to buy an option, right? Let's say you want to buy an option, and you want to put it in order, but you're not going to sit there and manually cancel replace every time the stock moves. That's not even feasible, and I don't think manually, it's not even an achievable thing. But if you want to buy an implied volatility and you want to put it in, that this is the limit, or this is the where I want to buy it, you'd have to peg it to the stock. Okay. That means it's going to cancel replace itself every time the stock ticks, your order will cancel replace itself. Now, if you're trying to compete to buy and you see that the specialists or broker dealers, whatever, let's say they're bidding 38 implied vol and you're willing to put 39 implied vol, you would put that in and then you would better the market. In other words, you start squeezing in the bid because you want somebody to come and sell it to you, right? So you're improving it and saying, and if a sell order comes in, you want to be the first one in line. So how are you the first one in line? Well, you have to be the best bid. If you're displaying a bid better than everybody else, and a sell order comes in to just sell it on the bid, you're gonna get it. It's competition. So that's what an implied volatility pump would look like, is that you're looking at this option, let's say, and you see that 38.5 is the bid, but you're like, well, I need this option. I'm not ready to go pay all the way the offer, but if there's a lot trading here and I'm trying to better the market, you put in like a 38.6. So you're putting in a pump, right? Instead of 38.5, you're putting in a 0.1 pump above that dealer. So market makers could also just put in pumps where they need it, right? And they'll stream their pumps. And that's how, and that's basically, that's the IB pump. It's a different way to try to execute your option order. It's a more efficient way, really, to execute your option order. The problem is that not too many places provide you with that ability, because from broker's side of things, it's expensive to cancel replace every order like that. Okay. So, but now that we see these, let's just say I'm looking for a put spread that I want to purchase. Well, for one, I'm looking at, okay, here's an option where the implied volatility, there's a pump on the ask side. So if I'm looking for purchase, I want to see somebody improving the market on it. I want to get a better price. And here's somebody willing to do that, because I could see here a 38.8 is below that IV, below 39 and 38.9. So maybe I queue this up on the buy side, but then I want to sell an option. And I see here's one with an IV pump on the bid, 39.7. I could see the one below is 39.5, the one above is 39. So I could queue up this option hit it on the bid for the sell. So now I found a potential put spread, right? We could run the analysis, but I found a potential put spread where the bid and offer still pretty wide, 20 cents, but now I do have information that where the option I'm trying to buy, there's a potential seller there willing to maybe negotiate lower. There's an indication there. And the option I'm trying to sell, there's an indication of a buyer potentially that even steps up higher. So it might be not only, that the pumps are moving it more favorably, because we could see that in theory, we already see a theoretical edge, but I could even negotiate for a better price than this 685, potentially getting a price right at midpoint, which would not only in theory be a good theoretical value, but also by saving 20 cents on this execution, what does it do? Well, it reduces number one, reduces my risk, because now if you pay less, right, the less you pay, well, the less risk you have on the table, because the amount you have at risk is what you pay for. And also it could enhance my potential return, because if I paid less, then if it goes up, well, I make more, right? Because I saved myself 20 cents. So if it goes in my favor, well, I not only did it go up, but because I paid less for it, I make that extra potentially 20 cents, right, that I saved. Maybe you could get it at 650, So that's ways that you could start using, these analytics and tools to try to help look at different ways to strategize around the markets. So, we're right up at 9:30. I think I'm going to.
Yeah, that was great, D. We did have a question popped in from Rob.
Okay.
Will, does Dean or and I don't, any broker offer an IV pump type bid to retail? I guess a broker that offers it on their platform where you can put it out there, I guess.
To retail, I am not sure. You could.
Next time we're on with Jeff, maybe we'll ask him that.
Yeah, we'll ask it. Yeah, I don't want to.
He runs the IBKR webinars.
Yeah.
So, and
yeah.
he works for IBKR, so he may know or have the question. So if you sign up, and I'll put the link in to sign up for the next webinar. Actually, you can even ask the question, but I'll try to remember to ask you that question, Robert, with the IBKR rep we know. Great job as always, D. That was a great look at NVIDIA. Thank you.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day and hope to see you guys